Thank you very much. It's a great honor to be here, especially to honor Raghu and his many, many accomplishments. I am too provocative to have been given a role in praising Raghu in public, so I will do it later during the evening. But I would like to sort of still say how much I learned over the years has been really a privilege to be a co-author of Raghu, and I've learned a lot in every dimension, not last sort of a human dimension, which is probably the most important one anyway, from him along the years. And so I decided to slightly change the focus of my presentation because I said a lot of Raghu's work, at least the part that has not been with me, a lot of Raghu's work is about what is unique in banks. And this is sort of seemed to be a topic quite important also, of course, for the Deutsche Bank Prize. The first winner, Gene Fama, is probably the one who started this debate in the literature, and as Doug has very well described, Raghu addressed this in many, many sort of works, starting with the dissertation and with work of many people here, and not here, like Stu Myers, Doug, Jeremy Stein, and Neil Kashyap. But in the sort of very much Chicago spirit, since this is a seminar, my role here is not just to complement his work, but also try to complement his work. So I will try to sort of discuss a role that he has not analyzed, and not to say that what he has analyzed is not important, it's very important. And maybe what is not analyzed is not important, but I will let you decide that. But to try to figure out what is the role that banks play, in particular on a very sort of old, and maybe that's the reason why it's been a bit ignored, because it's old and to some level trivial role, which is the transactional demand for liquidity. Now, clearly, historically, this has been an enormous important role that banks play. That's the sort of the first role. If you think about sort of the Italian, the Florentine, and Genovese banks, they were really started not only as a money changer, but also transferring resources from one place to the next in Europe at a time where sort of communication costs were extremely high, transportation costs were extremely high, and so on and so forth. However, sort of today we live in a different world. So the question today is this uniqueness of banks disappear as far as sort of transactional demand is concerned or not? And if not, what is the difference? Why people who want to sort of store some liquidity to buy something, they don't store it in an S&P 500 index? And you know, in the United States, most people now have a money market account, and they transfer with checks in the money market account. However, for some reason, they seem to be very obsessed with the fact that those money market funds must sort of stay at a fixed price of 1. And if they were to have a small fluctuation, at least this is the industry saying, then the demand for those funds will disappear. So can we really explain why, for transactional needs, we need something like bank deposits? And people have sort of argued that maybe there are reasons for asymmetry of information, etc. But you know, if I go to buy my sort of coffee and I turn over some shares in the S&P 500, I don't know more about the S&P 500 than the coffee maker, or vice versa. So I think that that issue doesn't seem to be very important. So what I will try to do in the short period of time I have here is to present a and I underline super simple general equilibrium model where there is need for liquidity. I was a few days ago in Budapest at the macro seminar of the CEPR, and I realized why sort of I don't like really dynamic stochastic general equilibrium models, which are what basically is the normal tool nowadays for macroeconomists. And the answer is because the computational costs are so complicated that they rule out any really inequality constraint. So basically, financial constraints, which is what I've worked for all my life, is ruled out by computational needs. And so I prefer to go to a SGE model without the D, so it's not a dynamic, it's just a stochastic general equilibrium model where finance actually plays a role, where financial constraint plays a role. So I will describe this kind of model where sort of people have liquidity needs, and what I will show is that people with liquidity needs will optimally hold a disproportionate amount of their endowment in riskless debt. And I will try to show to you that banks satisfy this need. And as a result of that, the reason why a negative shock to banks is so bad is that because it hits where people in need of liquidity are. So what is unique about banks are the people who hold their deposits in banks. It's not banks themselves, but they attract a kind of people, and hitting them is particularly bad. So if you're saying, what is the difference between the failure of Citigroup or the failure of General Motors, one answer is not the only answer, of course. There can be interconnectedness, a lot of story, but GM is interconnected as well. But sort of one answer is it depends on who holds those security and how much in need of liquidity they are. So let me start with the framework, and I promise will be super simple. So 4 dates, but basically it's a one-period model where there are only 4 dates for logical sort of reasons. And because we want to have a demand for liquidity, there must be a reason for liquidity. So we have 2 types of people in this model. Let's call them doctors and builders. And the paper is fully symmetric. In the presentation, for simplicity, we are going to assume that the doctors are going to go to the market first. And so they are the one in needs of liquidity. And of course, doctors consume building services, and builders needs doctors' services. And at date 1, they both have an endowment of wheat. This is a very simple economy. There is not even money here, of equal to E. And this wheat is consumed at time 4. And these people have the simplest utility you can think of. So they have linear utility in their sort of amount of wheat they consume and the amount of services they consume. So if you are a doctor, indexed by D, you're going to consume wheat, WD, and you're going to consume building services, BD. And then you have a disutility of labor, providing labor services, which is quadratic. And that is given by LD square. And the builders are perfectly symmetric. The only difference is they consume doctor services and they provide building services. Now, this is a model with a constant return to scale. 1 unit of builder labor yields 1 unit of building services, and the same for doctors. It's a model that is competitive. There are a lot of builders and a lot of doctors, so the market is fully competitive. However, there is no simultaneous double coincidence of wants. So the doctors I need my services from is different from the builder that provides the house to the doctor. Okay, so this lack of coincidence generates, this is go back to Gibbons, a demand for liquidity. And just for normalization purposes, price of wheat at time 4 is equal to 1. So just to give you a sense of the market here, the doctor will maximize their utility. So they will provide, they have a supply curve, which is equal to LD equal to PD. So they will supply as much labor as the price, basically. This is given by the particular form we chose. But what is important is why the doctors supply labor, because they turn those sort of things, those claims that they receive into doctor services that they are going to use. Sorry, into building services, and vice versa, the builders. Now, the only difference in the 2 supply curves is that if I am a builder, when I supply my labor, I need to factor in what is going to be the price of doctors when I go to the market second. Remember, the first time you go to the market, you have the doctors and the builders. So the builders supply, the doctors demand. they exchange, then the builders take whatever claims has been given by the doctors and go and buy doctor services. So that's the reason why their PB is discounted by PD. And this is such a simple economy that if you can pledge your future labor income, the equilibrium is one in which prices and quantities are equal to 1, and the utility is equal to your endowment plus half, which is the net gain from trading. And that's the end of the world. Okay, so this is extremely simple if you don't introduce a friction. Now, we are going to introduce the simplest possible friction, otherwise we don't have any finance and any sort of need for liquidity. And the friction is that the labor income is not pledgeable. Okay, so now the endowment becomes important. So far, I completely ignore the endowment, because if you can promise future labor, you can exchange on that. Now I need to know what I'm going to do with the endowment and how this endowment is pledgeable. Now, we want to keep the model as simple as possible, so this is going to be a model of complete markets as far as the endowment is concerned. So the endowment is invested in a risky technology, but this technology is completely pledgeable. Okay, so you can collateralize fully your investments and use your investments as claim in trading with the other partner. What is interesting, however, is that doctors who go to the market first, they need to have some claim to buy builder services. So when they invest, they are not only concerned about the return of their investment, they are only concerned about having enough pledgeable wealth to give to the builders in order to exchange. And so this is what is really important. So if agents learn about the true state of nature between time 1 and the time 2 where they go and start buying, then they are concerned about what is going to be the value of their endowment, pledgeable endowment, at the time they transact. And so if the value of the endowment is big enough in all the states of the world, then no problem whatsoever. If in some states of the world the value of the endowment is below the optimal level, then we have some friction. So that's the part we're going to study, is what happens if that's the case. And in the model, there are going to be n states of nature. Here, to simplify, we have just 2, high and low. And as I said, this is a model where the state of nature is verifiable. So you can have what we economists call arrow securities, so some funny securities that pay $1 in one particular state of nature. And here, there are 2 states of nature. You just need 2 securities to span completely. And you're going to have some intermediaries that manufacture the security. And because everything is pledgeable here, all investments, there is no issue of default on these intermediaries and so on and so forth. Now, what is important is, remember, this is a completely risk-neutral world because agents are risk-neutral. So in spite of that, there will be some distortion in asset pricing due to the lack of pledgeability of your labor income. And in particular, you're going to have that the price of a security that pays only in the high states is going to be below the expected discounted value, which in this case is pi divided by the expected return on the investment, which is R bar. And the price of the security in the low states will be higher because it provides some services. So before I go into sort of solving the model, let me give you the intuition, because the intuition is extremely simple. So even if you're going to lose the equations that are going to come soon, hopefully I can get you the intuition. So the doctors represent the people with liquidity needs because we chose, you could do the vice versa, but other ones who go to the market first. And so they would like to have at least 1 unit of wheat to buy the optimal amount of building services. So even if they are risk neutral in their utility function, de facto they become risk averse against the fluctuations on their endowment, because if their endowment falls below 1, they are not going to be able to buy enough, and they lose in terms of utility. If their endowment is above 1, they don't care how much above 1 they have, because once you have 1 of liquidity, that's enough to trade at the optimal level. So it's really a risk aversion against going below a certain threshold, given by their liquidity needs. So as a result, they will end demanding proportionally more of the security that pays in the worst state of the world. On the other hand, the builders are the ones who go to the market second. So they have the benefits of having some returns from labor income before they actually buy the services they need. So, of course, they want liquidity. However, their liquidity needs are limited to the difference between, one, what they need to buy, and what they get paid. Now, remember, if the doctors have enough liquidity, they're going to be paid 1, so their liquidity needs are 0. More generally, the doctors will not have enough, so they need to supplement, but their need for supplement is more limited than the one of the doctors who go first. So the builders are much more interested in the return of their investment than to have enough liquidity to pledge, because for them liquidity is less important. So they are naturally older of the securities that are paying more in a, actually pay, this security pays in a high state. So mathematically, this is very simple. What you do is doctors maximize their utility vis-a-vis the quantity XDH and XDL of other securities that they buy in the high and the low state, subject to, of course, their budget constraint that they can't buy more than their endowment. Now, just for analyze the first square bracket, just to give you a sense of what the equation is, sort of if I hold XDH, I can buy, as a doctor, 1 over PBH unit of building services. So, plus I have a utility from trading, which is half PDH, which has nothing to do with my holding of high security. In equilibrium, of course, will be determined, but if I maximize individually, that is a given number. I maximize given prices. And the builders are exactly symmetric in the other way around. And then sort of the supply of our securities will be done by intermediaries, and profit maximization plus constant return to scale assures us to have 0 profit. So these intermediaries will just break even. So how much do they get? They get sort of, if you invest 1 unit, you're going to get RH in the high state and RL in the low state. The prices of those states are QH and QL, so the sum of the two should be equal to what you invest, otherwise you will make money. With this, we solve, this is very simple given the simplicity of the model. Those are the market clearing conditions. And the key result is very simple, is that the doctors will hold proportionally more of the low R security and than the builders, and vice versa, the builders will hold more of the high R securities than the doctors. Now, what is interesting is when you go to end states, this generalizes, and what you have is that for the lowest security, the doctors will hold the larger proportion. For the higher security, the builders will hold a higher proportion, and this proportion are monotonically increasing, and they cross once. So at up to a certain point in the security space, the doctors will hold more, then the builder will start to hold more, and they will continue holding more. Now, why this is important? Because, you know, in two securities, very easy, it's actually trivial, to map this into debt and equity. In fact, we can say that the demand of our securities by the doctors can be satisfied by having an amount XDL in debt and an amount XDH minus XDL in equity. So you will have the minimum amount you want to have in both states in debt, and then the extra kick you're going to get in the high states is going to be in the form of equity. And similarly for the builders, and given what we have just shown, we can show, and this is trivial in two cases, that the doctors will own more debt and the builders will own more equity. Now, what is interesting is, now let's go to N securities, N states. We can see that their demand of security can be satisfied in this economy by a tranches of sort of securities, very much like CDOs, paradoxically, of different seniority. So imagine you have a stream of cash flow, and then you slice it according to different level of seniority. So the most senior tranche is what gets first, then the leftover go to the second tranche, then again, the typical waterflow of a CDO. Then, the doctors who are in need of liquidity will always hold more of the more senior securities, and the builders will always own more of the least senior securities. So, there is a natural order in which people in need for liquidity, they will buy the senior tranches, and people not in need for liquidity, they will buy the more junior tranches. Now, you say you're cheating a bit because you have shown this in our securities. Now you're talking about tranches, and what allows you to make the step from one to the other? And it says, sure, we can make that step. There are infinite other configurations that satisfy this sort of these characteristics, and it's absolutely true. However, and this is something we need to refine, but however, there is a natural reason why sort of tranches are better than our securities. Remember, in our world, tranches deliver exactly the same outcome as our securities, so they are no inferior in any form of the way, and they are superior in a very simple way, that our security needs actually to verify each state of the world. Because if I have a security that pays if the state is I, if the state is I plus 1, I get paid 0. So, you know, states are verifiable, but lawyers are expensive. So if you need to verify every state of the world, it's going to be extremely litigious world, especially in a world in which maybe you can transform the state. So if I am a manager, if I am an investor, and I know I get to be paid a lot if it is the state I, but it becomes the state I plus 1. Can't I sort of try to bribe the manager to pretend that is the state I by absconding some money or just wasting some money so that it becomes the state I and I get paid a lot? So the risk of litigation is much higher with our securities than with tranches, and that's the reason why tranches are better. Now, suppose we have these tranches and this economy, and let's introduce a Madoff shock. What is a Madoff shock? It's something that is not correlated at all with the economy. Now, if this was correlated with the state of the economy, things would be even worse, but we want to make things difficult for us. So let's take a shock that is completely random, not correlated with the state of the economy, in which one of these tranches, or one of the funds that are sort of filled with these tranches, has some problems and money has disappeared. And the question is, are all those funds the same, or are some funds worse than others? And given what we have built up to do, now hopefully the result is pretty obvious, and it is the fund we care the most about is the most senior tranche. Why? Because the most senior tranche is held by people who are most in their liquidity needs. So if I lose $1 in any fund, is $1 lost. However, if I lose $1 in the most junior fund, is only $1 loss because there's no implication on the working for the economy. But if I lose $1 in the most senior fund, then that dollar will cut down the liquidity available to the doctors. They will buy less building services. The economy will be trapped at functioning at the lower level as a result of this lack of liquidity. So both of them has the same direct effect, but the indirect effect through liquidity is much, much worse for the most senior fund than for the most junior fund. So Now, you can easily understand, hopefully, if I have not confused you, that the more senior funds look remarkably like banks. And this allows to explain what is so special about banks. And I'm sorry to say, at a sort of foundation of a bank, what is special about banks are its customers, are not its managers, are not its employees, are its customers. Because those are the people who need liquidity the most. So every time you have a failure to deliver in the banking sector, this failure to deliver has particularly costly implication because they hit liquidity-constrained people. So what have we done here? We have built an extremely simple, complete market framework where there is only one friction, lack of pledgeability of human capital. So basically, you can run away and not pay. Which sounds very much like the United States, a little bit less like Europe because they chase you back. But in the United States, you can run away in a different state and you start with a new name and nobody can get you. So with this sort of lack of pledgeability, we explain, I think, a very obvious fact, but a fact that at least in our view is not so well explained, which is why agents in need of liquidity own disproportionately assets that are particularly safe, and why, and this is pretty obvious given the way we build it, why losses in this type of asset has disproportionately impact on the economy. And this sort of seems to suggest why banks are special. Banks are special because this is where the liquidity is. And this is sort of not very different from what a very famous bank robber in the United States said. It was Billy Sutton. He was captured after robbing a lot of banks, and he was asked, why did he rob a bank? And he said, it's because that's where the money is. Thank you.
Okay, thank you very much for this super simple model in which finance really played a role in a macro framework. And I like very much your remark on the ESG models and leaving out the D. Okay, are there any questions? Or
So you mentioned banks are where the money is. How would this work if we had nominal contracts and there was a price level to move around? And would deposit insurance help here? I get the feeling that when the banks are failing, all of their asset prices are zero, so there's nobody to tax.
Okay, on the sort of nominal versus real, we have no money in our economy, so the difference doesn't exist. In the real world, of course, it does exist, and so we need to think about more how to address that. In terms of, sorry, the second question was?
Would deposit insurance help, or it seems like
in this particular,
asset prices
sorry,
are zero when
so far, we have really no default. So there is no problem of insurance or deposit insurance. Once we introduce deposit insurance against the mat of shock, yes. Against the mat of shock, absolutely. That will fix the problem. And that will explain why you want to insure the most senior staff and not the other, because the benefits are high, absolutely. In terms of more serious default of banks, we can introduce them if we sort of jazz the model more. At the current stage, there is no default in equilibrium except for the mat of shock.
okay, maybe I also would like to raise one question in the sense you have basically outlined that banks provide liquidity and therefore are very special, but aren't there other institutional devices which would basically provide the same kind of structure like money market funds you have been mentioning before?
Oh, absolutely. I think that I have to be clear here that the model does not differentiate between a money market fund and a bank. what does differentiate is between a money market fund and a mutual fund invested in equity. Now, you say, why do you need that differentiation? And maybe this is just the obsession of myself and my co-author, Oliver Hart. But I think it is a question why we don't use sort of checking accounts on the S&P 500, because it's fully liquid, and especially now where bank yields zero return, I think the expected return on a S&P 500 index is above zero. So we should use them, but we don't. And that's sort of a potential explanation.
I just wonder, your reasoning would not support a strong separation between investment banking and commercial banking, because the ones that have their deposits are in the highest need of liquidity, and saving them from any losses would have the highest return.
Let me say, I want to sort of respond as Luigi, because Oliver is much more cautious in making any statement, and I am less cautious. So I will respond as Luigi, and I say absolutely. And it says, I have a lot of other reasons why I want them separate, but I think that this model is consistent.
Okay, there was a question over there. Yeah.
I have the impression that the difference you make between banks and other financial intermediaries is perhaps a little bit limited. Does your model not indicate that gold, for instance, would probably do just as well and protect the economy, your economy, from all the confidence in bank staff that we encounter? So isn't it rather a proof that we have perhaps more certainty with commodity money, or in any case outside money?
Actually, no. And this is the paper that I initially wanted to present, which is an ancestor of this, deals with that problem. And in fact, the problem with gold or any commodity money is, and this is well known, but that model sort of make it very clear, is sort of creates an inefficiency, because here you invest the endowment in wheat in a productive activity. If you need a commodity or any other things to provide pledgeable value that is not at the same time producing a return, you are wasting some resources. So can you fix the problem with gold or any other commodity? Absolutely, but you create another one that might be bigger. So as often in economics, there is a trade-off.